Well, welcome back to Managerial Accounting. And this is, I believe, unless I missed something, the last video. So what I'll be doing here is I'll be reviewing the multiple choice part of the take-home exam. Just a couple of comments on this. Multiple choice testing is a reality in financial accounting. You never have enough time on exams, even if they're take-home, to test everything possibly that you can in the chapter through take-home problems. So the multiple choice is what tests the conceptual understanding of chapters, and it also enables you to cover basically everything that you cover in class, cover off all the learning objectives. So not surprisingly, people did better on the take-home part than they did the multiple choice part. Part of it is you had more time on the take-home part. Part of it was that the take-home questions were similar to the homework and similar to the ones that we did in class. The multiple choice are more conceptual, and you need to know the content. You also need to practice and get used to and kind of strategize on taking a multiple choice exam. So as I go over the multiple choice, be mindful of the things that that you may have missed, but also be mindful in terms of ask yourself, how did you prepare for the multiple choice part? Did you review the objectives at the back of each chapter carefully? Did you practice multiple choice questions, both at the back of the chapter and with the diagnostic tool? Every accounting book I've ever used in all the years I've taught always has multiple choice questions at the back. There's always, in a course like this, you have ample opportunity to practice with multiple choice questions. So I would encourage you all going forward. I'd like to see you all do well and succeed in your future coursework and your future careers, where they're going to be tests in the accounting and they're going to be multiple choice. Spend as much time practicing multiple choice as you do on practicing the problems and the homework, and you'll find yourself doing better going forward. I found personally when I took the CPA exam that the multiple choice part was especially challenging, and one of the ways that I practiced was prepared was just practicing as many multiple choice questions as possible. Okay, so without further ado, let's review the multiple choice. Okay, and I've highlighted the correct answer in yellow, and for Ramona and others who'd like to see how I got there, I've required calculations. I show you my calculations here. So a favorable cost variance, you have a favorable cost variance when the actual costs are what they should have been under standard costs. A cost variance doesn't have anything to do with volume, so you can forget the stuff about normal capacity there. So the correct answer there is B. When the standard cost actually exceed the actual costs, we'd have a favorable cost variance. Number two, which of the following is a reason standard costs are separated into two components? Well, those are all good reasons why standard costs are put into two components. Price and quantity need to be identified to correct differences. Identifying variances determines which manager must find a solution. And if a negative variance is overshadowed by a favorable manager, they overlook the potential correction. So those are all good reasons why you cut it into two components. If the price per unit differs from the standard cost per unit, the variance is called a price variance. That makes sense. So the answer there is C. Number four, this is the journal entry for a company that uses a standard cost system. So we purchased 6,000 feet of lumber at $6 per foot. So there's your credit to accounts payable of $36,000. However, the standard cost of material is $5. So 6,000 times 5 gives you 30,000. The difference there is the direct materials price variance. So when you use the standard cost system, you actually journalize the variances as they're incurred. So the answer there is A. Number five, the following data relate to direct labor costs for the current period. So this is the standard hours, and that's the rate. These are the actual hours, and this is what they paid. And they want the time variance here. So the time variance would be the difference in hours, which is favorable. You were supposed to spend 6,500 hours. You only spent 6, so that's $1,500 favorable, times the standard cost of $1170. So you have a favorable labor time variance there of 17,550. 6, a favorable volume variance could be harmful. Well, why would a favorable volume variance be harmful? What that means is that you produced more units than you expected to produce. And really the only downside of this thing is that you may actually produce more stuff than you can actually sell. So that would be the danger. Remember, if you have a favorable volume variance, that means you end up producing more units than you had planned. So if you can't sell those units, that's a problem. So the answer there is C. An unfavorable factory overhead controllable variance may be due to which of the following factors? Well, if you have an unexpected increase in the cost of material of utilities, that is likely to give rise to a unfavorable controllable variance. These other failure to maintain an even flow of work, machine hour breakdown, failure to attain enough sales orders, those are kind of tangential. The one that would actually most likely, the one that would give you your best explanation of a factory overhead controllable variance, which means that the variable costs exceeded what they should be, would be C, an unanticipated increase in utilities. Number 8, standard costs and actual costs for direct labor are as follows. The direct labor time variance, So again, you were supposed to spend 7,500 hours. You only spent 7,400 hours, so that's 100 hours. 100 hours favorable because you took 100 hours less than you had planned, and the standard rate there is 1180. So that's where you get a favorable balance of 1,180. Number 9, the ratio of operating income to sales, which in the DuPont formula is the return on investment, is called, that is profit ratio of operating income to sales, that's called the profit margin. Remember, you multiply that profit margin times investment turnover to get ROI, but what they're asking for is what do we call the operating income to sales ratio, and that is called the profit margin, A. Franchisor may provide support to the franchisees. The franchisor would provide all that support, advertising, management development, and supplier relations. Okay, number 11. So here it's a question of the range of possible transfer prices. The range of possible transfer prices, it should never exceed what you're paying the outside supplier, which is $350, and it should never be less than the variable cost to produce it ourselves, which is $325. So the correct answer there is D, $325 to $350. I didn't highlight it, but it's right there. Okay. Which of the following is a measure of the manager's performance working in a profit center? So remember, we have cost centers, we have profit centers, and we have investment centers. So a profit center is when you hold the manager responsible for profits. So you don't just hold them responsible for costs. So at D, it would be a divisional income statement, would be the measure of his or her performance at the profit center. Now, in an investment center, however, you're responsible for cost, revenues, and the actual investments in that amount invested. Remember, this is where the rate of return comes in. So if it's an investment center, the manager is responsible for D, costs, revenues, and assets invested in the center. Okay, what is the investment turnover? The investment turnover would be the sales divided by the amount invested. So 140,000 divided by 150,000 gives us 0.93. So the answer is A. Some organizations use internal support departments, which of the following would probably lend itself to be a support department. Those are all support departments. When you think of support departments, they don't make things. So I think my brother is a retired Army general, and they used to, when he worked in the Pentagon, they referred to him as staff puke, which is not a very nice term. But anyway, so those people, those departments that are important, but they don't actually produce anything that's sold to the customers, those would be your classic support departments. So human resources, payroll, accounting, information systems developments, learning or training, those will all be support departments. So the answer there is D. Most manufacturing plants are considered a cost center because they have control over costs. That's why they're called cost centers. Okay, so we're given some information here, and Steiker received an offer from an exporter for 15,000 units at $17.50 per unit. Acceptance will not affect normal production. The following data are available. the differential revenue from the offer. Well, the differential revenue, it's 15,000 units multiplied by 1750. Ramona, I think you asked me about this during the exam. It's 262,500 is my calculation, and there I find it. So when you see something written in here before the choices, that's my calculation. Okay, and this one looks very similar here. A special order for 25,000 units. It's $16 per unit. Acceptance of the offer will not affect normal. Following data are available. The differential costs from the offer. Differential costs would be the number of units times the variable costs. So 25,000 times 11, 275,000. And again, I forgot to highlight it there, but there it is right there, B. Okay, we've got can further produce product J to product D. Product J is currently selling for $20 per pound at a cost of $15.75 per pound. Product D would sell for $38 per pound if we required an additional cost of $8.55 per pound. Well, the differential cost for producing product D, therefore, is $8.55 per pound. That's the amount of the cost to produce it further. So the answer there is B. Number 20, which of the following should be ignored in make or buy decisions? So you consider cost, you consider quality, you consider future growth and other production opportunities. Wouldn't really concern myself with whether the supplier is making a profit here. So, if you have to pick one to ignore, I would ignore D. Let's not begrudge the supplier whether he or not makes a profit. Okay, 21, when using the product cost method, applying the cost plus approach to pricing, well, when you use the cost plus to pricing to determining your markup, you consider the total selling and administrative expenses plus the desired profit margin. So that's part of the pricing formula on the cost plus approach to product pricing. 22, the revenue that is foregone from alternative use of an asset, that's called opportunity cost. It's not sunk cost. Sunk costs are those costs that are not relevant, such as the undepreciated cost of a fixed asset. But opportunity cost, that's the revenue you give up by investing in an asset. So, if you had an opportunity to put money in the bank and get a 10% rate of return, then the opportunity cost is 10% of the investment. So the answer there is D. Okay, we've got a break-even question about an airline company. So to get the break-even point, it would be the fixed cost divided by the contribution per unit. So the ticket price is 200 and the variable cost per passenger of 50. So we're making 150 on each difference between the revenue and the variable cost of 50. So 12,000 divided by 150 gives us 80. And again, it got then highlighted. The answer there is B, 80. I see what happens here. Once I do my calculations, I forget to highlight it. Okay. The 5-year differential effect on profit from replacing a machine. So if I replace this machine, I'm going to be able to sell it for $1,500. It's going to cut my cost by $2,500. That's the difference between the 26 and the 23.5 for 5 years. But I got to pay $25,000 for it. So actually, if you take the salvage value that I'm going to receive, and you take the cost that I'm going to save, and then you subtract out $25,000, you actually, the 5-year effect on profit is 11,000 negative. So I wouldn't do this. You get a decrease there of 11,000. Number 25. So this one you had to actually do quite a few calculations. So to get the present value index, what you got to do is you got to get the present value of the future cash flows, and you got to divide by the cost of the asset. So I ran out of space here. You take each of the cash flows, so 180,000 divided by 0.909, 120,000 multiplied by 0.826, and this one multiplied by 0.751. You work your way down the line. Notice the further we go out in time, the lower these present value multiples become. You multiply out all these net cash flows here, what you come up with is a present value of $455,130. You divide that by the cost of 400,000, you get a 1.14, and there's my answer right there. 26, we're considering, we got a project here. Prada is proposing the purchase of an automated insertion machine. It has identified 3 machines and is asked to analyze them to which has the best cash payback. So the best cash payback would be the shortest cash payback. So you simply take the cost of the investment and divide by the annual cash flow. So I added this little line here, payback. I added that. That wasn't in the original exam. So 300,000 divided by 40 is 7.5. 250 divided by 50 is 5. And 500,000 divided by 75,000 is 6.67. So the one that is the best is the one with the shortest payback period, which is machine B, has a payback period of 5 years, which is less than all the other ones. 27, which of the following capital investment methods ignore present value? So the ones that ignore present value are the average rate of return and the cash payback method. This one, B, has present value. That includes present value calculations. C includes present value, and internal rate of return includes present value as well. So the average rate of return and cash payback are the only ones that don't consider present value considerations. Okay, which of the following recognizes that $1 today is worth more than $1 tomorrow? And that would be the time value of money concept. C. 29, they give you a bunch of present value tables here. Determine the present value amount. The following partial table represents $1. So you take 2 years at 12%, you get 0.797. See, I highlighted it here. Multiply that by 10,000, and that gives you 7,907. 2 managerial accounting tools useful in considering the uncertainty of estimates are, so these were the last 2 things that we mentioned. So you got sensitivity analysis, which is where you come up with a range of different possible cash flows. And expected value analysis, that's when you give various weights. If 50% chance of this happening, 30% chance of this happening, 20% chance of that happening. So the 2 methods for accounting for uncertainty in capital budgeting are sensitivity analysis and expected value. Sensitivity analysis, you have several different possible cash flows that you actually calculate. And expected value is you actually take all the different scenarios and you weight them by how likely they are to happen, with the weighting equal to 1. 31, which of the following is a qualitative consideration that may influence a capital investment decision? So all of those would affect a capital investment decision. And 32, in capital rationing, alternative proposals are initially screened for minimum standards using the following 2. So oftentimes, when you first go through the evaluation, you'll use the simplest possible method, average payback and average rate of return, and then use that to screen the projects. Those are your simplest calculations. Then the ones that remain, you use the more complex ones. So the ones that are used for originally screening are cash payback and average rate of return. Okay, so I hope you found that review useful, and I will sign out here. I think unless I missed something, which is always a possibility, one shark to another. This is probably the last time you're going to hear my voice. I've enjoyed having you all in class. I mentioned in my little speech that I've now changed my Brentwood to my favorite campus, and that reflects the experience that I've had with you. I hope you've learned during the semester. I hope you learned things about accounting. I hope you learned things about studying. And I hope you've learned things that will benefit you in your future career. It was a pleasure to have you, and I appreciate the opportunity to work with you, and wish you all well and enjoy your summer. As I said in the earlier tape, if you want to see how you did on exam number 3, you want to see what your grade is, just go ahead and go to Brightspace and look in grades, and you can get hopefully the good news. Be well, everybody. Have a great summer. Au revoir.